Hello and welcome back to another episode of the Investor Financing Podcast. I'm your host, Beau. On today's episode, we're going to talk about bridge loans or fix and flip loans when you're using the BRRRR strategy. So we all know the fix and flip loans, or maybe most of us know, that we can borrow between 85 to 90% of the purchase price and 100% of the repair costs, which are held back in a construction reserve. Gross loan amount typically can't exceed 75% of the ARV. The ARV is either going to be done by a full appraisal report where an actual appraiser goes out and does a full subject to completion appraisal, or some of our funds we work with do an internal valuation where they don't actually send an appraiser out. So it just depends on the lender. But when we're looking to BRRRR these properties, a lot of us are going into traditional 12-month fix and flip loans. I would highly recommend looking at a company that will lend on an 18 or 24-month term to give you enough runway to get your project done, to get a tenant in, to use new appraised value. Most lenders look at new appraised value after 4 or 6 months. Some of them, specifically to the short-term rental niche, will look at new appraised value for 12 months. So knowing what the exit strategy is going to be, I always look now for longer term bridge loans or fix and flip loans. Lenders will do a 12-month term, they'll do a 18-month or 24-month term. The longer the term, the rate goes up slightly, but it's well worth it because sometimes it's just easier to season the property for well over 12 months and then refinance. It just seems that everything aligns a lot easier that way. So in a market with rates moving up pretty much on a daily basis, they've come down a little bit, but overall, they've gone up significantly over the last few months. Hi, if you'd like to book a call with me and discuss SBA financing, whether it's a 7A or 504, or you just don't know where to start, maybe it's a startup business, you're buying an existing business, you're buying a franchise, you're building a new office building, you want to expand your existing business, we have multiple solutions. I can walk you through the 7A and the 504 and the SBA loan process. And if you have any other questions on any other types of financing, I'm happy to book a call with you. The link's below. Look forward to seeing you soon. It's a good time to lock in a longer fix and flip loan for the BRRRR strategy. This way you can kind of time the market a little bit better. And usually during inflationary times, rates go up. And then when they want to stimulate the economy again, they're going to start dropping rates like after every recession. So I think within the next 24 months, we will see rates come back down. Now, I don't have a crystal ball, but this is just a strategy to kind of hedge your risk by going into a longer fix and flip type of loan. I'm going to link up to a video we did on our fix and flip masterclass. If you want to watch that, we talk about all the ins and outs of fix and flip loans. Each lender has a little bit different appetite on what they like, where they lend. You know, are you buying in more of a tertiary or a smaller MSA, a rural area? Is it a heavy value add? Are you doing a very large rehab? That's really going to determine the best lender, is knowing the basics of where you're at, how many projects you've done, what city and state the project's in, how big of a rehab, what's the ARV, and then there's different strategies to kind of work within these different lenders because they all have a little bit different bucket. Some of them sell off in the secondary market, so their underwriting is very similar, but there are some big differences between lender to lender. If you have any questions on bridge loans, fix and flip, multifamily, SBA, feel free to give me a call or book a call below. Anyways, I look forward to talking to you soon and hope you're enjoying these episodes. I'll see you on the next one.